March the 11th, 2023. Got a quick shout out to our friends in California. A lot of flooding going on. Roads, creeks are up, all of the above. So if you got friends and family there, you check on them, make sure they are okay, and find out if they need anything that you can get to them. Don't leave them without communications. And whatever you do, again, check on the folks you know there. There's a lot of trouble going on. This article says 300 billion reasons why SVB Contagion is spreading to the broader banking system. SVB is a Silicon Valley bank, and you think California, but there was the police were called to their Manhattan office yesterday because they were concerned of trouble. People couldn't get their money out of Manhattan. They got them in Massachusetts. It's 18th largest bank. And what they did, they were called a VC or venture capitalist type of bank, where they loaned a lot of money to startups, and the interest rates were low when that started. And now Powell has hiked the interest rates up to where if you had money, this is just one of the factors, but if you had money in this bank or some of the other ones, you were making 1 or 2% maybe on your savings. But the interest rate at the Fed, when you're dealing with treasuries and bonds and all of that, what's it up at 4% or something like that? So Powell has outpriced a lot of these banks. And you think about the reset, it'd be a pretty good grenade effect on any type bank once you get to where it's more, and it's kind of ironic, but where it gets to where you make more money trusting the government with your money than you do your bank. And so you're kind of like screwed either way you go, to be honest with you. And so another grenade that's been put in there was major people like Jamie Dimon and Thiel had investments in this bank, and they pulled theirs and told other people to pull theirs. And so, but they're bigger banks, and that actually probably brought people into them. Another thing you guys need to know that we're dealing with SVB is that the owner of your company 2 weeks ago sold millions and millions of dollars worth of shares, and he was getting, that's when it was $240 or $250 a share 2 weeks ago. He didn't say anything about this coming, but why else would he do it? Now, like I said, he was getting $240 or $250 a share. I read something about it. But remember when we started covering this, it was at $174 a share, and then they shut it down when it dropped suddenly within 24 hours to $30-something a share. But he made his money. He didn't let any of you guys that have lost your money in on that. So several reasons there. And then they also have what's called a unrealized loss factor. And I want to show you a couple of charts, and not to go into detail about this because I'm not a banker and I don't understand all the jargon, but I'm learning a little bit about it just from this. So there's, again, what's called unrealized losses or something like that in the terminology. And let me show you what I'm talking about. And what it's going to show you is there's a lot of exposure to much bigger banks. When they start pulling the grenades on the little guys, though, that could come back on them. And I think we're leading into what the Feds hope to be the Great Reset. But this thing could collapse so quickly there may not be a lot to reorganize financially. We'll see. They're saying all insured depositors will have full access to the insured deposits no later than Monday morning, March the 13th, a couple of days away. The FDIC will pay uninsured depositors an advance dividend within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. In other words, it's a bail-in. As the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors. They insured up to $250,000. After that, you are on your own. Only 3-point-something% of that bank is insured. 3-point-something% of the deposits were insured because they were well above that. Again, venture capitalists starting up. A lot of these guys were dealing with new pharmacy techniques and things like that, startups. So, Pharmacia, and I will destroy those that destroy this earth. We're seeing the collapse of a lot of problems, but it's going to have an effect on every one of us, and we have to be aware of it, and we have to make decisions about how we're going to deal with it. It says, for those who slept through yesterday, here's what you missed and why the U.S. banking system is suffering its worst crisis since 2020. It's the second largest bank collapse in the history of the nation. It says the 18th largest bank in the U.S. with $212 billion in assets, of which $120 billion are securities, of which most of $57 billion are held to maturity, or HTM mortgage-backed securities. Now, what I understand about the HTM securities is that means hold to maturity or held to maturity. The bank cannot sell them. In other words, they're sealed, whether it's 3, 5 years or whatever, it can't be sold, and they have a value. And when the regulators come in, or they look at, well, what's the value of this today, if they're looking at the assets of a bank, especially one that's in trouble. And so if since there's no maturity there and the interest rates with the federal government are higher than what the banks are giving you, then it's kind of a cascading thing. But what happens is, if a bank has billions of dollars worth of these held to maturity assets, they cannot say, well, in 5 years they'll be worth this. What are they worth today? And that fell far short by $16 billion. They also have what's called a group of securities that they can sell, but it was much smaller percentage of their holdings than the hold to maturity. But again, it's a lot of jargon. I don't understand it all, but we're going to get to the chart, and I think that will explain it a little better, and you'll see some other people that are affected. It says funded by over $173 billion in deposits, of which $151 billion are uninsured. Has long been viewed as a bank as the heart. And we'll look at those charts, but it's funded by over $173 billion in deposits, of which $151.5 billion are uninsured. Has long been viewed as the bank at the heart of the U.S. startup industry due to its singular focus on venture capital firms. In many ways, it echoes the issues we saw at Silvergate, which bank crypto firms almost exclusively used. Now, Silvergate, I think, collapsed also. But it says Silicon Valley Bank stunned markets on Thursday after it announced a series of actions to improve its balance sheet flexibility and capital ratios as rates potentially remain higher for longer and private markets remain under pressure. Now, while many had speculated the bank may be facing a liquidity crisis in a rapidly rising rate environment, that's the Fed's, it took the management's team's confirmation that liquidity had collapsed to spark a bank crisis and a depositor run. The bank said it sold $21 billion of its available for sale. That's the ones I was talking about, called AFS, not the hold to maturity. $21 billion of those securities to be reinvested into shorter duration treasuries, and publicly announced raising $2.25 billion of equity, $1.7 billion common and $0.5 billion preferred, primarily to support its capital ratios given the $1.8 billion after-tax loss it expects to realize on the sale. They lost $1.8 billion to quickly sell them cheap. They knew the ship was burning, and they were trying to get money up so that they would not get taken over by the Feds. It didn't work. Now, they're saying we now know, courtesy of CNBC reporting, that this equity raise failed and the bank is instead trying to sell itself to a bigger bank. That did not happen. The Feds now have it. But just to go back on about CNBC a minute, 4 weeks ago, Kramer on there was saying, buy Silicon Valley Bank. Buy it. It's going to go up and up and up. So you can see the setup, and that's why I don't trust CNBC any further than I can throw them, but I just look at the numbers because that's all we had to go by. But the articles, they are as bad as CNN. Now, this chart is what's called the Silicon Valley Bank net unrealized losses. And you can see that it started going up dramatically this year. Check that out. Last year into this year. Here, it was all in good shape. And people didn't even talk about, according to the article, about unrealized losses in banks because there really were none. The interest rates were down low. The banks could make money on loans, things like that. Now that's pulled out from under them. And so they've got all of these hold to maturity assets they can't do anything with, and they're locked in at that value. So when when they start knocking on the door wanting to see your asset sheet, suddenly the difference, and they're calling it the vacuum, or the something like that, the vacuum between the actual value and what the perceived value going down the road is. So this chart shows 16 billion of unrealized losses at Silicon Valley Bank. Why is that important? Let's look at a few of the other banks, and I'll show you why. Notice the same time at the bottom down here. It started in 2022 and it continues now. This is December 31st of 2022, and we're past that point. It's called the Big Four net unrealized losses, and they don't want to talk about this. They know that it will create what's about to happen. Bank of America, top in the red right there. See that? We're dealing with billions of dollars. This is unrealized losses. Their scale matches Silicon Valley, JP Morgan, Citibank, Wells Fargo, and they had trouble yesterday. So it's not just the Silicon Valley. Even though 18th largest bank, offices all over the nation. This is what the real picture is right here, and you're looking at it, guys. So prepare accordingly. Monday is going to be something to see when the market's open and when the people start coming to the bank to get their money back. But remember, only 3-point-something% of the money that they lost is insured, and they won't get that back. But they're saying they're going to hand out some more or less you own a portion of the bank, probably something like that, a dividend, but you'll never see it because they're not. What are they going to do? Powell has put them out of business. The larger banks are helping, but this is what the larger banks' balance sheet looks like here. So who's fooling who? Again, I'm not a banker. I know this is just kind of a rough analysis, best I can do with it right now. There's a lot of other information coming out. I'll link to this article, but you can just type in Silicon Valley Bank and read and go into as deep into the rabbit hole as you want to on this. But I think the big factor is, again, the fact that only 3-point-something% is insured of all that money. And these four big ones right here have the same chart on their sheets. We're watching it. You watch it. It's a heads up. Be safe.